Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, and we're up to number 55, Income Protection Insurance. Before we kick off, there's my disclaimer: facts, figures, information only. It is not advice. Income protection. I probably believe in many cases that income protection is more important in many cases than death cover and TPD cover, in the regard that this is something that's far more likely for you to make a claim on. Yes, we'll all die, but not hopefully when we're younger, and suffering a total permanent disability is, generally speaking, very unlikely as well. But income protection is basically there to replace our income, providing something has happened that your doctor says you should not be at work. So this could be depression, this could be a back pain, this could be a broken leg, and so it goes on. And because any number of situations there. So it's anything basically that your doctor says you shouldn't be at work, and we've got some certificates and so forth to prove, then yep, generally speaking, we can make a claim. Now, income protection can also be called salary continuance. Pretty much means exactly the same thing. But it's there to give you some bit of a backstop, provide you with some income to still be able to pay your expenses if you're unable to work. But it's got to be due to sickness or injury. It can't be because you've been made unemployed. That's not, your income protection will not cover you for that. It's purely for sickness or injury. It's available in most super funds, and pretty much nearly every super fund these days will offer you some form of income protection or salary continuance. If you purchase income protection outside of your super, meaning you go to a company like your Colonials or your AMPs and so forth, and purchase purchase income protection, your premiums are indeed a tax deduction. So that can be quite useful, especially for people who are self-employed and looking to get some tax deductions there, need to protect what they're earning and so forth. It's a tax deduction. Inside super, it's not a tax deduction because superannuation is a concessional investment anyway. But of course, it means that if you do want to pay for it, you could do it as salary sacrifice to pay for your premiums, income protection inside super, to effectively get the same result. Now, income protection does not cover you for your entire salary. Generally speaking, in most cases, it'll cover you for 75% of your salary. And in many cases, they'll also pay you your super contributions as well. So you might be getting your 11, 12, 15.4 or whoever you're working for, getting those added to going into your super. At the same time, you're getting 75% of your salary. Remembering that a income protection payment is also still taxable. So obviously, if you're only getting 75% of your salary and that amount of money is taxable, then obviously our net income has certainly decreased. Now, of course, the premiums, like with any insurance, the older we are, the more expensive they get. And so if we can look at ways of reducing our premiums, generally speaking, the best way to do that is to look at the two parameters around income protection. The first one is the waiting period, meaning how long do you have to be sick for before you can make a claim? Now, most income protection will offer you at least a 30-day wait or a 60-day wait or a 90-day wait, meaning you've got to be sick for either 1, 2 or 3 months before you can actually make a claim. 30 days is usually the shortest. But some super funds and other income protection outside of super might give you 120 days or 180 days. And I have even seen income protection that will give you either a 1 year or a 2 year waiting period. Now, obviously, the longer the waiting period that you have selected, the less risk you are to the insurance company. Therefore, your premiums have indeed gone down. So the idea here is to look at what leave entitlements you've got. So if you've got yourself, 3 months worth of sick leave, you could say, well, okay, I can just rely on my sick leave until such time as it runs out in 90 days, in which case then I'll select the 90-day waiting period on my income protection, and therefore everything's fine. Now, of course, you'd need to review this every so often as you eat into your sick leave and or you build up extra sick leave, remembering that you don't have to use up all your leave first. So you don't have to, you might have had 6 months worth of leave, but only taken a 90-day waiting period. That's okay. That's okay. It just literally means that after 90 days you can start claiming on your income protection, and you've saved your sick leave perhaps for a future period of time. Now, most people, however, would normally use sick leave because it pays you 100% of your salary, whereas this income protection, of course, I say, is only paying you about 75% of your salary. Probably come down to your age. You know, an older person closing in on retirement would probably just want to use up all their leave as best as they possibly can before they go. Whereas someone young might decide, no, look, I wouldn't mind having at least have some sort of sick leave up my sleeve for those odd days where I'm just not feeling well enough to go to work, but I'm not going to be sick for 30, 60 or 90 days or so. Now, you can adjust these periods whenever you like. Now, of course, if you adjust your period from 30 days down to 120 days, you are becoming less of a risk to the insurance company. Therefore, you just need to put that in writing, and most income protection companies will literally just have a form, an insurance adjustment form. And you can fill out that form, send it off, no problems. But if you're going the other way, that you've got a 90-day waiting period, and you decide, no, look, I really do need to have 30 because I don't have much sick leave left, and you drop it down, you are becoming a higher risk to the insurance company. Therefore, yes, anytime you become a higher risk, they will ask you to do a medical questionnaire, and they want to know why do you want to change your waiting period. You know, they just literally they want to know, is there something wrong with you before they do it. And of course, with any of these things, if you fill out medical questionnaires, they can indeed knock you back. Now, normally, if you go to one of these income protection application forms on your superannuation website especially, it'll just literally be a 1 or 2 page questionnaire, and you run down the document going, no, I'm fine. At the end of the process, you've probably just got your insurance almost approved immediately. If it's a case that you tick a box that say, yes, I've got asthma, then it would normally open up a asthma questionnaire, and depending on the severity of your asthma, it would either be a case that, yep, you're still approved, okay, or they would know you might get an exclusion, meaning you're covered for everything apart from anything to do with your asthma, or you might get a loading, meaning that your premium is a little bit higher because of your asthma. But so have a look at the waiting period to ensure it matches what you are trying to achieve and what you could afford to do without income coming in. On the other end of the scale is your benefit period, meaning how long, if you get sick, how long can you be sick for and have this income protection to keep on paying you? Now, most of the income protection inside super is either 2 years or 5 years. Most income protection outside of super will either offer you up to, all the way through up to age 60 or 65 or even 70, and that's your benefit period. So obviously, if you need longer or believe you need a longer benefit period, you may, if your superannuation fund doesn't offer it, you may want to look elsewhere outside of super to get that longer protection. But again, it's up to you. You know, if you think, okay, especially if you say you're closing in on retirement, you've only got a few years to go, then having a shorter benefit period is not really a major problem there. So again, the shorter your benefit period, you are less of a risk of what it's going to cost the insurance company. Therefore, if you reduce it from 5 down to 2, that would be no problem. But if you went from 2 years to push it out to 5 or up to 65 or whatever, then a further increase, you would need to fill out the medical questionnaire. Most income protection policies and so forth will include having some sort of rehabilitation process built in, because what they want to do is they want to get you back to work quick as they possibly can. And therefore, they will probably provide quite often free rehabilitation. It's cheaper for them to get you back to work than it is to keep on paying the policies. Again, just check your policy in the fine print to see what is indeed available. Now, these payments of the benefit period up to 2 years, 5 years and so forth, it is per ailment, meaning that let's imagine you were hit with some form of cancer perhaps, you were off sick for a year, but then you had treatment and you've basically been able to go back to work. And so you've been sick for a year. You go back to work, but then unfortunately the cancer comes back, and therefore you do not have to apply, you do not have to sit through the waiting period. You've already been approved for that particular condition, but because you've used up 1 year of it, if you only had a 2-year benefit, you would only have 1 more year available to you for that condition. If, however, the first time you used it was for your cancer, but the second time you came because you had a broken leg, then effectively, yes, you get 2 years for the broken leg, 2 years for the cancer, 2 years for whatever each ailment may be. So I suppose if you're ever going to get sick, just make sure it's something different every time. Now, of course, be careful too if you've got multiple super funds, especially, that you might have income protection in 2 or 3 super funds. You might have income protection outside of super and get automatic income protection with your super. Now, unlike death cover and TPD cover, where if you've got multiple policies, both policies will pay, with income protection, you can't imagine that one company is going to give you 75% of your salary, another company gives you 75% of your salary, and all of a sudden you've got 150% of your income. I suppose you'd never get better. You'd stay sick if you could, literally, to get the double income, the increase. So literally only one account will pay. You can't get more than your income. Get more than your income. So if you're paying premiums in 2 different accounts, you're paying a premium for something you're not going to get the benefit of. If you read the fine print, you may find that one company will pay you 75%, and the other one company might pay you the 25% to get you up to 100%. But you won't get more than the 100% generally speaking. So you're paying premiums for something you're never going to get the benefit of. Also read your fine print, because some of them, it literally, even though you might be paying a premium for a salary of 90,000, some of the fine print says that if your income in the last 12 months was only 60,000, that's all you're covered for. So this is where it becomes a bit, check the fine print. What are you actually paying for? A guaranteed income amount, or your actual income over the last 12 months or so. So now, of course, if the income was higher than what you paid for, you're not going to get paid on that. It'll be either your one you've paid for or your lower income, whichever the lower there. So please make sure you understand what goes on with multiple accounts and so forth, to ensure that you're not paying premiums for something that say you're not going to get the benefit of. Make sure that you keep your super fund up to date with your salary. Some employers, literally, like the government and so forth, will actually contact on your birthday the super fund, updating them on your salary for their income so that it automatically goes up. But many other super funds know they're relying on you to tell them what you're doing. And also just check with any insurance relating to these death cover, income protection and so forth, what work category have you got? Many super funds will automatically pigeonhole you as a blue collar worker, meaning you're a labourer or something like that, where there are higher risks. If you're working in an office, you're a white collar worker, just check your policy to see, are you indeed paying premiums for something risks that you are definitely not taking on board? In which case, if you're a white collar worker but it's saying that you're a blue collar, literally just contact your super fund, notify them immediately to get the reduction in the premiums. So a fair few things there to check, but please check, have a look and see what you've got, see what you need as far as what sort of leave entitlements you've got, and obviously how long it's going to pay for, what's it going to worth, and if it doesn't pay you enough, what are you going to do about it? Have a chat to us if you've got any issues. Look forward to you joining me again on another session.